One of the most common misconceptions we've seen over the last decade at Nomad Capitalist is that Americans cannot move overseas and take advantage of the same tax savings that everyone else can. And today I'm going to give you an updated version, plus new details on how Americans can lower their tax rate overseas as low as zero. I'm here in the home office today and wanted to respond to some of the latest folks talking about this on our video on moving to Uruguay and how you can reduce your taxes to as low as zero there. A lot of Americans saying, hey, that doesn't apply to us. Don't you know? We have what's called citizenship-based taxation. Well, yes, I do know. I have been talking about that here at Nomad Capitalist for a dozen years. I'm a former U.S. citizen who was an expat and filed tax returns. And I know exactly how it works. But today I'm going to tell you some of the exclusions, exemptions, and other tips that you can use to legally reduce your tax rate to as low as zero, why most Americans won't pay zero but can get their tax rate overseas into the single digits, and compare that to tax savings onshore. Really quick, I am not a professional tax advisor. This is not tax advice. Nomad Capitalist works as a sort of general contractor to connect our clients to a network of subcontractors whom we help coordinate for them so that when you move overseas, you've got the entire process managed under one roof, from taxes here and there to immigration and everything in between. So let's talk about citizenship-based taxation. What this is it means if you hold a citizenship in that country, they will tax you no matter where you live. This differs from what most legacy brand in Western countries have, such as Canada, Australia, the UK, which is what's called residential-based taxation. We've talked about this numerous times. People are often getting confused. The difference is citizenship-based taxation follows you no matter where you live and includes all of your income from all global sources, whereas residential taxation only includes income from global sources when you reside in that country. Canadians, Germans, Australians, they all have a way to get out of their tax system. Some of those countries are making it harder. Some of them are imposing more barriers. Some of them follow you around for a couple of years afterwards. But you can get out of their tax net. With the US, you cannot. And so people think it stops there. Hey, if I move somewhere else, Uruguay, Malaysia, anywhere in between, I'm just going to pay the same taxes I would in the US. Why would I bother? Sure, the cost of living is lower, but it's not worth it for a 7 or 8 figure entrepreneur, the kind that we work with. And so yes, it is true that your global income needs to be reported on a US tax return as long as you're a US citizen. It is also true that you will need to report your foreign bank, brokerage, and other foreign financial accounts to the U.S. Treasury as long as you're a U.S. citizen. And because of those requirements, there are some banks around the world that simply don't want U.S. citizens as a customer. But the IRS even says that on their own website about the exclusions you can use. They say a common misconception about the Foreign Earned Income Exclusion, which we'll get to in a minute, is that the excluded income does not need to be reported on a U.S. tax return. Now, for many years, I watched as a lot of Americans, including many of our clients, legally paid zero on their tax return, but they still had to file one. So the issue for a lot of folks, particularly those who maybe have a low 6-figure salary or below, is merely the paperwork requirement. You've got Americans who live in Canada as dual citizens who they don't have a lot of money, but they've got a really hinky tax setup to where they're being punished by citizenship-based taxation. What I look at it is, particularly for entrepreneurs, you can move overseas and you can lower your taxes using a number of tactics. So let's address the 4 ways that you can legally reduce your taxes as an American. The first is domestic. The next 3 are overseas, what we specialize in. Number 1, simply you stay in the United States, you take tax deductions, you get your bill as low as you can, and you just suffer through it. Robert Kiyosaki spoke at our live event, Nomad Capitalist Live, a few years ago. He talks about buying real estate using depreciation. I've always thought, number 1, I want to be more diversified than only buying assets in the United States. I don't want to keep all my eggs in one basket. I don't think the best returns are in the United States. And yet, it also just seems to me like you're engaging in inorganic behavior, where you're going out of your way to do something to save on taxes. You wouldn't necessarily put all your money into those properties, or you wouldn't necessarily move around business expenses, or incur extra business expenses, or incur them at a certain time, if it weren't for trying to reduce your taxes. And so I don't begrudge anyone who wants to stay living in the United States. I quite frankly think everyone should come to our live event, for example, and they should see what it's like to spend time in a foreign country and realize, hey, it's actually better out here. But if you want to stay in the US, that's great. But realize, I don't think it's the best tactic to just take a bunch of deductions and lower your income tax. And by the way, no matter which state you move to, your taxes are always going to be at the federal level, at least. Now, let's talk about moving offshore. There are two types of people we're going to talk about in this. One is people who have passive income. You're a stock trader, you have dividends, you have capital gains, you have interest income, you're buying and selling Bitcoin, anything like that, which they would define as passive income. You're not really working for it in their mind. Now, yes, you can classify yourself as a professional trader in some cases if you are a professional trader. I can't recall seeing that many cases where that actually helped, but that's something that's out there. Let's just call it passive income. If you're engaged in passive income, you've got fewer options. Now, if you're an entrepreneur, you have more options. An entrepreneur is where you have an active income, and generally, we want to define this as someone who's earning money from an actual business enterprise. So if you're a freelancer, if you are a one-man or one-woman show, that's going to be something that may not qualify. You want to run a business where you could step away and the business keeps running, at least in some capacity. At least you want to have maybe a couple people working for you. So those are the two camps we're going to break it down to. Here's the three options. Number one, you can move to Puerto Rico and take advantage of Act 60. Number two, you can move overseas to anywhere in the world. There's 251 other countries and autonomous territories to choose from. Autonomous territories being places like the Cayman Islands, for example. Not a sovereign country, but they run their own tax policy, which in their case is zero. Number four is the more extreme step that I eventually went through with after doing number three. Number four is you renounce U.S. citizenship. So once you give back your passport, you're going to pay $2,350 for that. There may be an exit tax, which is something to consider, particularly if you've hit a $2 million or higher net worth. It would be ideal to get out before then to make your life easier, or get out before your income gets too high. And so once you do that, depending which passport you have, you may be able to return to the United States. It may be more difficult and you might have to obtain a visa. But once you're no longer a U.S. citizen, you're out. Foreign banks that wouldn't take you might now start taking you. Investment opportunities open up, and you're just out of the U.S. tax system entirely, and you can choose any of those places to live in and pay 000 across the board. So we've talked about renunciation, plenty of other places you can go and look that up. Let's focus on steps number 2 and 3. If you are into passive income, Puerto Rico's Act 60 allows you to get your taxes down to as low as 0. Now, you can't simply move to Puerto Rico and sell all the Bitcoin that you've been accumulating over the last 7 or 8 years on day one of arriving and say, hey, I don't know anything. There's a process of how long were you here, when was the asset acquired, and so on. You actually need to live in Puerto Rico. People think because it's a U.S. territory, they just kind of go and pop their head in. No. Puerto Rico, in my kind of simplistic assessment, is kind of like a Canadian, leaving their country and being what's called tax non-resident. You need to, if not weaken your ties in the mainland U.S., you certainly need to strengthen them with where you're going, which in this case is Puerto Rico. And so you need to have, all the accoutrements of life based in Puerto Rico. It needs to be your most significant home, and you actually have to spend significant amounts of time there. And so for me, I chose not to live in Puerto Rico because, particularly being single at the time when I renounced, I thought to myself, I'm going to be limited to the U.S. dating scene. I'm going to be kind of stuck on this island. They're always in the news for the power's out, that kind of thing. I mean, yes, there are some people who go to Puerto Rico and they enjoy it. I also know a lot of people who go and move there, and it's just like, listen, I'm gonna cash out my Bitcoin bag, and then eventually I'll go back and live in the mainland. That's what I want to do, but I could save some money, and I'm willing to put up with that lifestyle adjustment. Now, because I haven't seen as many people who move to Puerto Rico because, I just love Puerto Rico, we have not seen as many people move there for business. You can lower your tax rates on a business to as low as 4%, but again, there's some requirements, and so not every business is going to qualify. You've got to set yourself up properly. But let's just say, if you do it all perfectly, potentially your passive income could be taxed at 0, and your business income could be taxed at 4%. Okay, it's not quite that simple, but let's just take those two numbers. So those are pretty low numbers, and so that's a place to move. Again, particularly if you're in favor of passive incomes, you don't really have that many other choices. Now, the other option is to move overseas. This, to me, is what we mostly help clients do at Nomad Capitalist. And again, if you're not an American, you can simply go through a tax non-residence process and you can exit your country's tax system. I do think that some other countries will make it harder to leave in the future. We've already seen Australia being a little squirrely. We've seen other countries like the UK talk about, and the Netherlands talk about imposing exit taxes to leave. But the US is still unique. And so, what particularly an entrepreneur can use, also a salary earner or a freelancer or anything like that, but what an entrepreneur in particular can maximize is what's called the Foreign Earned Income Exclusion and everything that goes with it. So in 2025, for taxes filed in 2026, it's $130,000 per person per tax year that you get to exclude. Now again, the IRS says you still have to file a tax return. You have to tell them what you're doing. But you can exclude $130,000. And there's not a lot of requirements for like what you need to be doing to do that, but you have to meet one of two tests. Number one is the bona fide residence test. This one's a bit more subjective. Bottom line is you need to find a place that you live. That becomes your new home. Again, a little bit like a tax non-residence process. Hey, I'm moving here. And then you've got to build a case. Do you have a residence permit in that country? Or are you a citizen of that country? Maybe you obtained citizenship by descent in Italy, and you're going to go and take advantage of the tax incentive for freelancers in Italy, for example, and you want to go there. Or hey, maybe you just want to go and get a residence permit in the UAE, and you want to get paid as a freelancer there, get your taxes potentially down as a freelancer to 0% in the UAE. Hey, that's your home. You're going to spend time there. What having a home looks like is what that test is. There's also the physical presence test. You pick one or the other. The physical presence test is basically you're out of the United States for all but about a month. And it's not based on how much time you're in the US. It's based on are you spending 330 days in a rolling period outside of the United States. There are a few places that you can't go, so like Cuba doesn't count. Time in Cuba doesn't count. There's a few exceptions of like, hey, if you're here or if you're doing this, or if you're on a cruise, for example, if you're on an international waters cruise, if you're like traveling around the world on a cruise, that may not qualify. And we actually had, I think years ago, somebody who worked on a cruise ship couldn't qualify because you have to spend time in foreign country or countries to qualify. So for someone like me who didn't necessarily want to spend the majority of my time in one place and wanted to be nomadic, particularly when I left the US, I took advantage of this one where, hey, I just won't go back to the US, in my case at all. In your case, it might be just not very much. It might be, hey, I'll go back for a month, a year, and I'll make sure I'm out by that time. If you do either of those tests, either one, you can take $130,000 a year. Now, it's each person. So if you're married, you can each take that. Now, I've seen different approaches from different tax advisors. The more conservative approach, I think, is let's say you own a business. Yeah, if your wife doesn't really work in the business or your husband doesn't really work in the business, that's something to take a look at. I'm not going to give you, this is not tax advice, but you want to play it straight. But if you are engaged in earned income, it's the Foreign Earned Income Exclusion. If you have earned income, you can take off $130,000 of that. There's a few other things you can add. For example, you can take foreign housing credits. There's different ways that works. I think the last number I saw was about $38,000, up to that amount. If you have certain passive incomes, just like small amounts of interest income, for example, you may be able to still take the standard deduction if you would otherwise take that. And you may be more likely to take the standard deduction than if you were in the United States because you've excluded that income through the Foreign Earned Income Exclusion. Now you're saying, listen, Andrew, you work with 7- and 8-figure entrepreneurs. What's $130,000 a year? Well, what you can do is you can use foreign corporations. Generally, we recommend, particularly for Americans, tax-neutral foreign corporations, to run your business through. So you can set up your own foreign company. You can employ yourself, which I think a lot of Americans don't quite understand, given like the use of LLCs. You are the owner of your business, but you also are an employee in that business, and you have those two roles, particularly when you're entering this U.S. Offshore tax system. Let's say your business makes $1 million a year. You can keep the $1 million, you can take the salary out. Now, for the longest time, you could pay just 0%, and as long as you never wanted to take the money out, well, you didn't have to pay anything. And you can use that money, you can make investments, you can buy property, you can do all sorts of things with the money in your company. Well, what happened was they introduced GILTI, G-I-L-T-I. It's pretty complicated stuff. There's some really intense formulas in there, but bottom line, for most of the people that we would talk to, if you use a little bit more complicated corporate structure, you can reduce the actual amount of tax that you pay to about half the corporate tax rate. So Trump lowered the corporate tax rate to 21% while introducing GILTI. Theoretically, if he were able to get the corporate tax rate down to 15%, now some of the elements of the Tax Cuts and Jobs Act, which will sunset this year, are being renegotiated perhaps. We'll see if the corporate tax rate became 15, would you pay 7.5? But the bottom line is, right now, you can pay about 10.5, all things being considered. There's many different factors that can go into this, but let's just take a kind of a simplified example. You could pay 10.5% on the overage. So my example, let's say you and your spouse both work in a business, and you're taking out each $130,000 from your business, $260,000 in total. That means that's what you as employees take out. Your business that you own has $740,000 in remaining profit. In this ideal scenario, that could be taxed at 10.5% when you set up a more complex corporate structure. And so 74% of 10.5%, give or take, that's about 7.5% total tax rate. So we're in the single digits. Now, that's assuming that you've set up your company in a tax-neutral jurisdiction. So depending on what kind of business you're running, it could be a simple, down and dirty British Virgin Islands company. If you need a little bit more complexity, Hong Kong generally works if you don't live there. And if you need something more complicated or for a niche case, Cayman Islands can work, and then the Isle of Man. There's many different places that you can go and have a tax-neutral company. It also means you haven't moved to somewhere like France, because if you're a tax resident in France, even though you're not a citizen, they will tax you on your worldwide income. So you want your company set up somewhere that's tax-neutral, and that can be the same place that you live. You can set up a Cayman Islands company, then go and live in the Cayman Islands. They will let you do that. Not all countries will. But if you live a tax-friendly lifestyle, the cool thing about being an American is being always a U.S. tax resident. You can go and you can spend time a little bit more liberally than maybe someone who's tax non-resident of Germany could in certain countries before you get sucked into that tax net. So you can travel around the world. You can do as I do and have homes in different places. You can do whatever you want. But if you become, a tax resident, if you're spending the majority of your time in one high-tax country, that could be an issue. If you're spending the majority of your time in a country that has a territorial tax system or, let's say, a non-dom tax system, you may be able to keep your tax in that country at zero. So it's the U.S. is an element, where your company's incorporated is an element, and where you choose to live is an element if you get sucked into any tax net. For years, for my own lifestyle goals, not as a tax strategy, but just because I didn't really know where I wanted to be all the time, I was never sucked into any other country's tax net. And so I just had to deal with the U.S. and I had to deal with where my company was incorporated. Pretty simple. So it really depends on how much time you want to spend in any one given place, whether you have two countries to contend with or potentially a third. And so that's kind of a simplified example. Now, I said you could potentially lower it to zero. Yes, potentially on that passive income in Puerto Rico, but if you're an entrepreneur, you can do it too. Here's a story. I was talking to an old friend of mine. He's Canadian. He owns a business 50-50 with an American guy, U.S. citizen. And they were talking to me about, hey, one of these days we're going to hire you again and we're going to leave. We're both living in Canada. And I said, that's great news for your American business partner, because with you owning 50% of the company, that means that he can basically step outside of the GILTI system. So if you have a foreign business partner, or if you have a foreign spouse, and that foreign spouse owns your business, or if you have a number of people who are foreigners who are involved in the business, that could be a way to potentially step outside of that 10.5% or whatever percentage it may be in the future regulation and get down to zero. Now, for me, as someone who legally paid zero using some of these same techniques to the United States for many years, the most difficult thing that I realized once I renounced was there are restrictions on how you take the money out, and that's an extra thing. That's a whole topic for another episode. But there are some restrictions on when and how you take the money out, and so you can't just dividend all the money out to yourself. When I gave up U.S. citizenship, one of the things that I did is I started accumulating more real estate around the world. I had some already, but it became easier to say, okay, I'm not a U.S. citizen. The place my company is, they're not going to impose a dividend tax, and the place I'm living doesn't have a dividend tax. So I could just take out money from my company, obviously within the rules of running a proper company. I can take that money and I can go out and invest it in property or other things in my name, because I'll tell you, trying to reinvest money in a foreign corporation in various assets can be confusing for some of the other people involved. And not that that's so bad, but it's just more explanations to have. And so for me, one of the more difficult things that you really never get away from as a U.S. citizen overseas is nobody outside of the U.S. really understands your tax situation. They're like, why would you buy your home in that company? It's like, well, it's a complicated thing with a foreigner. They're like, what? You pay what? Why do you pay taxes? You don't live there. And so that is the kind of thing. By the way, that's why people come to Nomad Capitalist. We understand the unique plight of Americans. And yet, unlike most U.S. tax advisors, we also have experience with about 15 different offshore jurisdictions that we work with on at least a relatively frequent basis. We deal with banks all over the world, not just for Americans, but we do know which ones accept Americans. And by the way, sometimes the list is shrinking. There's certain banks that get out of dealing with Americans. And so we have a global perspective. We have clients from all over the world, but we do help Americans. And my own experience has been fed into the company over the years to where you're not going to just talk to somebody in the U.S. and get the U.S. side. We're going to make sure you get connected with all the different parts. And I mean, we have American clients, there might be 8, 10, 12 different parts to their plan to make sure everything's done properly, to make sure you reduce your taxes as much as possible. And even unknown unknowns. I mean, for example, if you're going to own rental property in the United States and you plan on renouncing at some point, there's certain things you should be doing to make sure that you're not going to get back into the U.S. tax system. And so this is the kind of stuff that we help our clients with. We work with actual tax professionals, not only from the U.S. and in the U.S., but in all the jurisdictions that you might want to go to and where you need help with, as well as the places where you're going to incorporate. We do it all under one roof. And we do it because I believe you have the right to be able to lower your taxes as much as legally possible. You do not have to pay 30, 35, 40% or even more taxes when it's all said and done just because you're an American. I do happen to think that Americans should have a second passport. I do think if you've lived outside of the country long enough, and especially if you've limited yourself to that physical presence test, eventually a lot of people are going to realize life is just as good, if not better. Certainly feels more free, certainly feels more relaxed in many ways living overseas. You might just decide, hey, I'm glad I had that second passport. I don't want to be American anymore. There are too many restrictions. From my experience, it felt a little constricting. It wasn't about, do I owe something? Now, for me, U.S. citizenship was not particularly valuable. I kind of wanted to get rid of it as a kid before I even had a tax bill. I just didn't think it was my place. But whether it's your place or not, I think what you'll realize is, hey, if you had to pay some small amount of tax to become an American, let's say, in my example, 7.5%, that's not the worst thing to do. What bothers me is the unfairness of it. And what bothers me is how they put various restrictions on you, even though you don't live in the country. It kind of violates the whole point of how taxes work. You don't live there. Why are you paying for it? So for me, I think there's a philosophical component, and the longer you spend outside of the United States, the more you might connect with that. But the first step is making that move. We can help you with that at nomadcapitalist.com/apply. Learn how we bring more options than anybody else. Learn how we put everything under one roof. If you have an income of $500,000 or more, or if you have a liquid net worth of $1 million or more, that's where you go, nomadcapitalist.com/apply. We'd be happy to help you. If you're not quite there, you go to nomadcapitalist.com/live and you'll learn about the aforementioned 4-day live event where you can come and meet with folks and hear from our team and start getting your strategies together on your own. Those are 2 ways that we help folks, including a lot of Americans, legally take back control.